It's Thursday, 4 o'clock. It's time for the Real Estate Happy Hour.
Man, we are back at it. Warrant Hairband is loud and in stereo.
Warrant is singing about some Cherry Pie, one of the great hits of the 80s, man.
And they are bringing in the hottest show on Facebook.
Hey, they are good. They are good. Let me get this down just a hair there.
Let's tweak that a little bit. So, listen, we got... This week, we got a brand new Money magazine that we're going to touch on and talk about some interesting stuff we pulled out of there.
Absolutely. Got some great stuff there. Then we're going to talk about, getting back to the basics of real estate. Talk about the different kind of mortgages and what the best mortgage for you and your family is.
Some loan programs, huh?
Loan programs.
A list of loan programs we got out there.
Hey, there's some funny ones too, right? I mean, stuff that is pure junk. But even Jay Williams wouldn't get. Also, we're going to just talk a little bit about this crazy real estate market because it has gotten a little bit crazy.
A little bit about home sales and things like that. So let's kick it off. Money Magazine this month. Listen, interesting, quick little bit on the best times to fly. You guys might already know this, but the cheapest, best fares out there are typically in January and September. Is what
Makes
they
sense.
said.
Well, obviously, you get kids in school. They're trying to get that person.
January's right after the holidays,
right?
So you've already spent up all your travel.
And they're trying to encourage that family to go out there and take advantage because most of them are not. They're going to wait till March and summertime. So
and in September, right after school starts, most families aren't traveling again.
Hey,
right?
Nope, that's exactly right.
That's true. Worst times to fly. This is probably obvious. March. Which,
I get it. Spring break
season, July, middle of the summer, and December, Christmas time, obviously, one of the worst times to travel. So, moving on, we had an article on some colors for interviews.
Yeah, even though I'm an Auburn guy, can you believe when you guys are going out, when you're going out to get that job interview, Carrie Ballinger, make sure you don't wear that orange blouse because orange. According to Money Magazine, the absolute worst color.
Absolute worst. It's been labeled as unprofessional. They said hiring managers prefer blues and blacks. What I thought was funny about this is they talked about what color that you wear to an interview. What does that portray about you? Gray was logical.
I qualify there.
Okay. White is organized.
I qualify there.
And brown, I thought this was interesting. If you want to bust out a brown suit
or
something
brown.
like that. Dependability.
Well, I have to be that too, right?
But so those portray logic, organization, and dependability.
Makes sense, though.
But yet the hiring managers prefer blues and blacks.
Well, and two, what's interesting too is I remember, it's funny. Somebody did a study of like the presidents in times of like when national tragedy happens or
what they
something
wear.
happens, the tie they wear, and how
Oh,
blue confidence, whereas red would always be. A power move.
Yeah, red's always sparked a little anger, I guess.
I guess that's why Trump loves it, right? Because he's trying to get one over on you.
But that was the last thing, was to accentuate pops of color with a tie or a blouse for women, things like that. So,
hold on, real quick. George Moyer has been waiting for us to be on time for a long time. He's a huge fan, but he's one of the smartest guys I know. Good to see you, George.
Perfect. And Michael Bruno, the purple leisure suit, yes.
Well, yeah, especially if you're going to see Ben here at Mortgage Bank.
If you're trying to make a statement, roll in with that purple leisure suit. It's going to work.
Absolutely.
It's happening. Hey, next up, I thought this was great. It's funny how, I guess, I don't know, maybe I'm just old, but, you get into your little community of life, your way of doing things. You don't even notice there's like this whole world of
something's changed.
Whole world of things going on around you.
Right.
And these little side jobs, the side hustle that people call them. You got Lyft, you got
Uber. You're talking about the Eats, the
Grubhub. You got
Grubhub.
Shipped. You got all kinds of stuff. Well, now Amazon has Flex. It's their Flex delivery service jobs. It's very similar to all these other part-time gigs.
Absolutely, and it's not just the ones that are driving the Amazon Prime vans. That's not what we're talking about.
No, this is very similar to like Lyft and Uber, where you have your own car. You have an app on your phone where you sign up for blocks of packages and you go pick them up, it's a last mile. And they quoted a guy from Auburn, actually, talking about last mile delivery. So these people pick up and deliver that last mile for Amazon. It was amazing. Customers bought over 180 million items from Amazon between Thanksgiving and Cyber Monday.
That's crazy.
It's only 4 days. 180 million items.
And UPS just gets overloaded year after year after year.
And if you've ever bought anything from Amazon, which probably everybody has, not everything is put together, right? So those 180 million, that takes a lot of people delivering.
Well, one thing that is, I know that the article talks about them paying well, but my question is whether or not after they pay for their gas, all those things, because they're not paying expenses back.
Yeah.
Obviously, they're not dumb enough to make you an employee.
Right.
So you're an independent contractor. Are you really making? Because they say the average Uber driver makes less than $10 an hour at the end of the day.
Yeah, and it's funny. They said that the initial pay starts from about $18 to $25 an hour. Sounds great, but after expenses, you're looking at roughly about $5 to $11 an hour. Now, the article did mention that Bezos has committed to paying everybody $15 an hour. Amazon employees
works out for nobody when they do that,
but Flex is not part of that. Flex is not part of that
because you're not an employee. But at the same time, one other thing to remember is that I know I've talked to a number of folks that were Uber drivers or Lyft or whatever, and one of the problems that you really got to look at is making sure your car insurance will cover you. Right. In the event that you're even carrying one of these packages.
Now that you're running a business out of it.
Yeah. I mean, because, Uber and Lyft have had to come in and go, okay, we'll insure over you. But what happened to some people is that their own insurance carrier went, well, hold on. You're driving for them, we're dropping you.
Yeah, and it was amazing how competitive this was between the drivers. Like they had one guy talking about he has figured out his Camry so well that he knows how to pack his load, and he's got everything planned out. He uses Waze app instead of the Flex app because he feels like it's better. He won't even drink any liquids an hour before taking a block because he's
it wouldn't matter for me.
Doesn't want to stop and use the restroom. Man, I even read about this one guy who created a contraption designed to automatically grab blocks. He put together a clicker with cardboard, styluses, and a computer fan.
People are nuts.
Because they weren't able to get them quick enough.
Well, what about what have they said about one concern that I've had about this whole business model is what happens when a package arrives broken?
Yeah. That's a very interesting topic. Plus the porch pirates that they
what happens if I put it out there correctly? And a lot of the guys are actually, I've noticed from another story, is taking pictures of it once it arrives.
Yeah, they take pictures and send you the picture. But the porch pirates is a thing. I saw something on the
internet. So bad, the porch pirates.
Yeah, they see your Amazon packages and run up and take your stuff.
Well, it's sad that we have to deal with that, but
these guys actually have to plan around that.
What do they say about that, though? Do they say anything about what happens if it's broken or any of that happens?
No, they didn't say anything about that, but they did say they do try to be conspicuous, either put it around the side of the house or hide it in some way around the front door.
Right. Well, amazing. It is what it is.
Amazing. A whole business. They've got a whole community, YouTube channels, all kinds of stuff around this.
People will find a way to make money, and they'll find ways to make ancillary money from this.
Very interesting. Very interesting.
Moving on.
Next, we have got our interest rate update. Man, they're trickling down. Okay,
just a little trickle.
Yeah, which is nice. If everything goes according to plan, the Fed might have pulled this off temporarily. Right?
Well, the Fed came out yesterday and gave some guidance, not official guidance,
right?
But spoke out and basically said why they did what they did from the last meeting when they said that they're going to slow any movement on interest rates because they just felt like they did not want to slow the economy at all. And probably they are correct. That was a real concern because when you started seeing not just the Trump wing of politics, but you had the Democrats all going, hey, hold on a minute. Things are going pretty good.
Yeah.
They just simmered down a hair.
Yeah, and I think they really backed off because they saw some of the effects that quickly rippled into the housing market and that they don't want to mess with. They don't want to shake the housing market too much.
Well, no, and because the housing market's taking care of itself, we can shake ourselves
Right.
without any help.
Right. And so right now, 30-year interest rates average, this is, again, Freddie Mac Mortgage Market Survey. Average 30-year rate's 4.35. Average 15-year is 3.78. Now, those do come with some points and fees, so if you want to look that up, go do it. And
But one thing to remember is that 30-year, he's at 4.35 today. When you were on your cruise back early November, because that's how I remember it, we were pushing right at 5.
Yeah, early November was really the changing point. That first week or so of November was when the Fed came out and reversed their statement, and then rates came falling down.
And you look at that 0.65. Some of you may be saying, "Hey, that's not really a lot." But in terms of where we've been over the last 10 years, when we stayed right at that 4 and we didn't deviate from that 4 too much, went up a little down. We never really swung that fast up, and we came right back down. I mean, what I'm saying is that 0.65 is a big swing.
Yeah, absolutely. Absolutely. That's a big deal. And you tell anybody, that we're, 4.25 or 4.375 today versus 5%, I guarantee you they're a lot happier to hear that than the 5%.
Absolutely. Who wouldn't be?
So, moving on. Slowest home sales in over 3 years could help buyers this spring. Now, this kind of tails right off of these interest rates on what's going on in this market.
And let's give credit where credit is due. This comes from our friends over at CNBC, who I actually like. I don't like anything else NBC, but I do like CNBC. I think they run a good operation. Sales of existing homes fell 1.2% to their lowest level in 3 years nationally. Now, I would say that 3 years in Birmingham, Alabama is 10 years, not 3 years. We are way low here in the Birmingham market. But as they said, that prices, are starting to cap off, but they still rose at their lowest levels, though, right?
Yeah. So prices are rising, but at the lowest levels, like you said. Interest rates obviously have something to do with this, but I think last year we really had some shakeup in the market with rates running up, with the inventory problems, with multiple buyers. It's still February, so we're still ramping up into our regular real estate season, which is really March, April. And I think things have definitely picked up. Things are definitely better than they have been on average the last 3 months. So I think all of this is just coming together right now, and I think it's really going to help out.
Well, the market,
March and April.
I think one thing to remember is that we want to act like we were in a very overheated market, right? It was very overheated. I mean, the fact is we had prices rising faster than they should have been.
Yeah, we had no inventory.
No inventory. Things were happening like they could. Finally, appraisers were giving us values.
Yeah.
Because we were seeing a little bit of pushback at the beginning of that.
So this low home sales actually helps us out because we've got inventory adding on, which is what we needed. We've got rates cooling off, which is what we needed. And, the low home sales just means that this stuff will build up to make more of a healthy market when we swing back in March and April.
And one thing,
in my opinion.
Well, it's your opinion, but it's a good one. No. We've talked for weeks about the affordability of the lower-end entry-level houses. Entry-level housing, but that's right around $100,000 for our market, right? Is at we're down 15% compared to a year ago. That's very important because a lot of that for many years,
thank you, Dave,
was coming from builders actually building houses for that demographic,
right?
And they just totally abandoned it. And what we have got to get housing in that area, because what's happened is what used to be a $100,000 house is now 130, 140, and those folks can't afford, that entry-level person can't afford it, and then it affects all the way up the chain.
Yeah, absolutely. And any bump in interest rates affects first-time home buyers, especially because they're new to this and they can't stand, shocks to the budget. And then also, the down payment options definitely changed from $100,000 to $130,000, $150,000.
Yeah. Well, here's my problem is if you can't afford a down payment, call me crazy, but if you can't afford a down payment on a $100,000 house, I'm not so sure your rear end needs to be buying a house, right? I mean, I'm just saying. I sell real estate.
And that's His name's Collier.
Yeah, it was true. I mean, what got us into the problem was.
We're going to talk about some loan programs here in a second. One of the ones we were making fun of earlier, but it's true. In order to be a part of this and make an investment in yourself and to invest in housing, it does take a little bit of financial management, money management,
Call me
saving
crazy.
some money, putting a little bit of money down.
Be wise with your money. That's all I'm saying. Be wise with your, I mean, look at what we talked about a few weeks ago with that movie. What was it, The Big Short?
Yes.
If you look at the movie The Big Short, I mean, you had a stripper in that movie owning 4 houses that were very expensive as investments.
Absolutely. I mean, there was the mortgage business in general wasn't taken seriously. We were giving anybody loans that could fog a mirror.
Not you.
And
you were only giving good loans.
We were coming up with all kinds of ways to put people in houses regardless of the ramifications to the borrower, really, because at the time, we thought real estate was never going to go down. All right? Real estate was on a ramp to the moon, and everybody was buying as much as they could. More back to this story, I think, is interesting that first-time home buyers lately have been about 29 to 30%. It goes to your point that you were just talking about on the affordability side, that in the past, they have always averaged about 40% of sales, and right now that's down around 30%.
So 11% difference. More than that, I guess, if you calculate it differently, but about down 11% from where they should be. And you say, you know what, I'm moving up into a $500,000 home. How does that affect me? Well, somebody has to buy your $250,000 house, right? And that's usually those people that are on the 125 that are doubling up, that are getting a bigger house. So it directly affects that chain. And somebody asked me the other day, well, what about those ones over $1 million? Well, that has a totally different environment because there's so few people, at least in Birmingham. So if you're watching nationwide, who cares? Or if you're Sarah Adams, you can afford $1 million house.
Oh, of course, Sarah can.
I mean, that girl is loaded. But anyway. So just think about that as we go through into this market, because it's a weird market. There are deals to be had out there. You're just going to have to act fast when you do see it, because there's a lot of folks that still want to get out of their house, and there's so many loan programs that are available to buyers, and that's what we're going to talk about next.
Yeah, and my takeaways is just that the market is coming right into where we need it to be with the time of year that it is. We're adding some houses. That's probably Sarah Adams laughing at us. But we're adding houses, rates are staying put, so should be great to get some people into these loan programs, right?
Absolutely. And one of my favorites is the conventional loan.
So let's just talk a little bit. Let's hit some highlights on some of the different loan options out there. First one being a conventional loan. It's interesting when I talk to people, the information that they do have and what they come up with. Some people prefer an FHA loan first, and they just really don't know the difference. Really, I'll start off with credit score, and we'll talk about this briefly, but anywhere from 600 to 700, typically I'll lean towards an FHA. 700 to 800, I'll lean towards a conventional loan.
Say that again, because that was very fast.
Usually from 600 to 700 on the credit score. Okay. I'll lean towards an FHA because, in my experience, that's probably going to give you better overall financial picture. 700 to 800, we're going to lean towards a conventional loan and look at the numbers.
And then what if you're like Sarah Adams and you have an 880?
Oh, Sarah Adams, definitely conventional.
Conventional, okay.
So the benefits of conventional, obviously, a lot of programs have a low down payment. Anything less than 20% down on a conventional loan, we're going to require mortgage insurance. That's private mortgage
Less than
insurance.
20, I get mortgage insurance, all right?
Yeah, that's private mortgage insurance. You can use this for a purchase or a refinance. And typically, the mortgage insurance is also based off a credit score. So you can save some money with your credit score on that mortgage insurance as well.
So credit score is, and then when I go get my homeowner's insurance through the same process, I'm getting that pulled too.
Yeah, you're going to save some money on the homeowner's insurance with a good credit score too. So back to, fiscal responsibility, right? Saves you money all the way around on that conventional loan. The next one is FHA. Now, conventional starts off around 3% down. Okay, so
let's walk through that, because
we can do 97% financing,
5%,
5% down would be 95%, and then
that's right,
10 and 20,
95 plus 5, 800.
So 3 to 5.
Where does we're getting to that, George? We're coming to you.
Yeah, we're coming to that VA. Next, let's hit the FHA. So FHA is 3.5% down. Okay, the biggest differences on FHA is that FHA is more lenient on credit. Okay,
and now one thing that I think is a big misnomer is it's not stand for anything regarding first-time home buyer.
Look, Jesse Adams joined us too. Look at that fella.
Sergeant Carter.
What's that? First-time home buyers?
Yeah, first-time home buyers. A lot of folks think FHA stands for some kind of first-time home buyer assistance or something like that. It's Federal Housing Authority.
Right. It does not stand for first-time home buyer.
Use it.
There are very few first-time home buyer programs, which is funny. They are out there, but some people like to call programs different things just to make them sound good.
Call me crazy, and you're the mortgage guy, so I still have an opinion on this. But FHA I don't like for a lot of cases because I think that I can be in a conventional loan because there is not a funding fee, but a FHA upfront mortgage insurance.
Yeah, it's upfront. It's mortgage insurance premium. So the difference between conventional is private mortgage insurance. FHA is mortgage insurance premium. Now you pay some up front, 1.75%. That's financed into the loan. So almost 2% of your loan amount. So let's say your loan amount is $200,000. You're paying an extra $400,000. You're going to roll that in. Your new loan is going to be $204 roughly. It'll be a little less than that for those people that want to.
All right, but what about my analysis has always been I would rather take that instead of paying a fee of 1.7. I would rather take 1.5 and throw that into so that I have equity.
Okay, so here's the deal. Whenever we're kind of splitting hairs between FHA and conventional, we really don't have extra down payment. Okay, so we are either fighting to get that 3 to 5% down on a conventional, or we're getting that 3.5% on an FHA, and we're financing in. The biggest problem is financing in that upfront mortgage insurance and then the monthly mortgage insurance, which now does not go away on an FHA loan. The conventional does go away. It used to. At 80%.
It used to, and I just think that I would rather put that 1.5 towards it and then still get the seller concession for the same difference. And now I have an extra 1.5 of equity in the home instead of making the big banks richer.
Yes. Now, where that'll hurt you again is just going to be credit score. I mean, if you're looking at a mortgage insurance and a rate on a conventional loan in the 650s or so, then both your rate and your mortgage insurance is going to get hit. So that's why the FHA a lot of times will be more attractive in that situation.
And more in my line of thinking related to making sure we make good personal finance decisions with our income stuff, I've always said try to avoid FHA if you can because it means you've made it to the big leagues. It made it to the big boys. You're getting a conventional loan. It means that you had enough money to put a down payment. You had enough money to protect yourself. And we're going to get to it with George Moyer, right, about the VA.
Yeah.
There's situations where, in this market, where we may be hitting some peaks, that George may not want to lock in a long time on that VA, right, because of the funding fee that we'll talk about. So I'd rather you be putting money in.
Yeah, see, the funny thing is, like, I love the VA loan. There's a lot of good benefits to it. Some realtors, some other people don't like it. We were just talking about a scenario.
I like the veterans, just not the VA loan.
Well, we were just talking about a scenario upstairs where it might not make as much sense, and that is definitely out there. So the VA loan, the biggest thing about it is it's 100% financing. It is only available to veterans and anybody that qualifies for that. Thank you for your service. Fairway is a huge supporter of our veterans.
No one bigger than me and David. And
that is a big deal.
Hey, George went around the world on a big ship.
And the VA loan is a great benefit. The only downside, the rates are typically better.
Yeah.
Okay?
That's right.
Look, and they are lenient. Like they will let stuff go, like debt to income, which you may say that's not a great idea, but in some situations
but you get somebody
some situations it makes sense.
But David, you get somebody like George who got good credit. He's got, I assume you're being smart with your money, which I know you are. And he's got a family. To me, it's not causing a strain to him to put 5-10% down and be, to me, in a better situation. Let's give the example of what we talked about upstairs, just in numeric numbers.
Yeah. So the VA funding fee typically is 2.15% for first time use of the Loan amount.
Loan amount. Okay.
Yeah. So if it's a $400,000 loan, 2.15% is going to be almost $9,000.
Right.
Right. 8,800, something like that.
Okay.
So that was 400,000.
Yeah, 400,000.
So subsequent use though is 3.3. Now,
subsequent use meaning your second time to use it.
Yeah.
So if George has already used it, he's going to have a higher funding fee.
Yeah. And so on that, I think
0.5.
the example that we were looking at was a $450,000 loan was $14,000, almost $15,000.
So they're going to roll that back into the mortgage amount. So in other words, the reason we were talking is actually for one of my clients, and we were discussing that literally they are, if this market has topped off for some reason, for whatever reason, they are $14,000 in the hole. There's no other loan program that'll do this, by the way. But it just goes, roll it in, right? And so they're $14,000 in the hole before they get back to the par value, which would be the amount that they paid.
Yeah.
So if they haven't increased from that, they're now $14,000 in the hole. Now the question that the difference in this situation was there was maybe $8,000 down payment, right, into the thing because it's 100% financing, very low down payment versus $35,000, and I get it. There's a big difference of the amounts, but. The biggest question is, what does somebody like George do? As long as he saves that money, he should be fine, right? He saves the $20,000.
Yeah, you got to look at the, maybe you're getting a better interest rate on the VA loan. Maybe, you definitely have to put that money away that you're saving, the down payment that you would be putting on a conventional loan versus the VA. There are some situations where if you receive disability from the VA that you're exempt from the funding fee. So, hey, the VA is a beautiful loan then. You don't even have the funding fee. So
do it if you can get away from that 2 point, because that's why I don't like it. But the other thing I don't like is the idea of 100% financing for smart people.
Right. Plus,
look, not smart people can do the 100% too. I get it.
But see, the deal is, though, on a VA loan, you don't have mortgage insurance. You don't have monthly mortgage insurance. So really, on the 2.15%, even on the scenario, we ran the numbers. And I think the funding fee at the 2.1 before the subsequent use, the first time was a little over $12,000. But if I did the monthly mortgage insurance, added that up over the 7-8 years they're going to pay that, maybe the numbers were pretty comparable. It was still in that $12,000 range that they were going to pay for mortgage insurance. So, you really just have to look at everything. If you've got the VA option,
and the other
again, I like it.
Well, and George, you can talk about this maybe at some point, but these people that are active duty, right? I'm not so sure you don't just try to, protect yourself a little bit more when you're active duty, because you are going to be spun out of wherever you are in 3-4 years, right? You don't have a choice when they're going, George, get to Japan. Okay, I got to sell. It doesn't matter if I'm underwater or I'm not, and I don't want that VA to hold us up.
Yeah. Because
my wife went to Rooms to Go and decided to go crazy because we saved $20,000. She spent it all.
Yeah, you don't want to do that.
Now USDA, talk about that.
Next one, USDA. So, obviously right now I'm not a big fan of the USDA because of the government shutdown. Now, having said that, the government was shut down. It put us on a 4 or 5 week backlog. Today, we are not backlogged at all, but I think that's because we quit taking those applications for a little while. I looked on the website today, and they said they were currently reviewing files received on February 20th, which was yesterday. So everything's caught up with the USDA.
Talk about a USDA, though.
The government's running. The biggest thing on a USDA, it's 100% financing. It's got to be in a rural area.
And by the way, when we talk rural, let's talk rural 1960s and before, because they really haven't updated the maps, and we're talking rural areas that used to be rural but are now.
Yeah, you'd be surprised at a lot of areas that do qualify for the USDA.
Absolutely.
It's really easy to Google and look up where that qualifies. I know in years past we've done a lot of loans out in Chelsea.
Alabaster. That's south of Alabaster, Collier.
Which
Mark Carlisle may be listening.
Very populated areas, which most people wouldn't say, that sounds
They
rural.
have McDonald's, they have Walmart, they have Cracker Barrel.
So, you think about that, and there's income limits. I think they're around $73,000 is the income limit. There's a couple other things depending on your household size, and you can get some break on that income limit for daycare expenses, things like that. Interest rates are good. The mortgage insurance, talk
about that. Is this an FHA loan type?
No, they call it an annual fee. Okay, it's the lowest. annual fee, mortgage insurance, whatever you want to call it, out there, really. Okay? So it's not a bad deal either. It's just, in my opinion, sometimes they get backed up, and it's a third party getting involved doing that loan.
Yeah, McAdory. Yeah, that whole area of Bessemer.
Yeah.
Right outside of Hoover.
So the USDA loans are good. I'm just not a big fan of it right now because the government shutdown created a backlog. They've caught back up right now. So if we don't have any change to that government shutdown, then they'll be fine.
Well, if we're talking about like Jesse Adams here, there are also things out there called jumbo loans. What is a jumbo loan?
Yeah, jumbo loan is going to be anything over $484,350. That limit, keeps rising every year. I'll tell you, jumbo loans are kind of they're just not as common. So, a conventional loan, they set guidelines for $50,000 up to $484,000. So the conventional box, if you will, captures all of those, right? The jumbos are individual companies, individual investors, and they can all make their own rules. They're buying, most people try to break up a $500,000 just to get it right under. So they're buying 700, 900, a million, 1.2.
So when y'all finance that, are you saying
loans?
Are you saying that Fairway still sells the loan, right?
Yeah, they're still an end investor on that jumbo loan. So
gotcha.
If you're the one taking that $1.5 million loan and you're reviewing it, you're obviously going to review it pretty
probably. Yeah.
And there's something you don't like about it,
right?
We can't go to a guideline book and say, well, no, right here, tell
you
us
have to
we're
take
okay.
it.
I mean, you have to pretty much play by their rules. So that's not to say that just to say that any kind of strange scenario really needs to be thoroughly examined, and that's where your loan officer comes into play on looking at guidelines, reading what you have to do for different situations, because you go back to that borrower 3 and 4 times asking for clarification and more details, more paperwork. They're going to get frustrated, especially in a price range.
Well, and I think
a jumbo loan.
Well, you like mentioned
Jesse
it.
Adams.
Yeah. Well, you mentioned it just a second ago. The splitting of the loans, and what he was talking about was getting one loan at the max of what did you say, 486? 44, and then another loan for the amount above so that they could stay in the conventional area.
Yeah.
And have a normal guidelines, and then
so see people like Jesse, they just put his wife on the loan, and he's like, man, I'll just sign the title.
Yeah.
And then you only got one borrower, so you only have one set of questions.
I mean, she's loaded. And
they
have a swimming pool.
He's like, I don't even have to worry about this.
Well, one thing that he does not need is a FHA 203K loan that I'm telling you, go to your average lender. They love these.
Yes. Man, it's interesting. We do the 203Ks, and I think that it's a great idea. Listen, the renovation piece of it, but I just find it
it's very cumbersome.
A lot of clients that hear about it, once they get into the details, they're not interested.
It is expensive to relative to a normal loan. You do have expenses percentage-wise that come out of it for fees, because you now have to pay the lender to come out and take a look. Not David, but they send a what do you call it? What do you say? An inspector out?
Yes.
Every time there's a draw on the, you have to hire a license. You can't do
your work yourself.
Absolutely not. Why? And it makes sense why. I mean, there's a lot of.
We're not going to give you a check.
Yeah, there's a lot of rules that the feds have created and these big banks have created that is dumb.
I think it's a good loan.
But this is good. It's a good loan, but you guys just don't like it because the problem is.
No, I mean we don't. I don't have any problem with it. I think clients don't understand it.
Well, that's what I mean.
Once we get into the details and explain it to them, they're not a big fan of it.
Well, not when they can go buy another house for $20,000 more and get everything they needed in there.
Yeah.
The next one is, and this is somewhere where if you're working with a mortgage lender like David, they'll work a plan out how to do this, but is your typical construction loan, which it can also be a alternative to this 203.
Yeah, okay. Construction loan. Now, we are just a mortgage company, so we just do the residential mortgages, first mortgages. The construction loan is more of a short-term, local bank type of deal. So we don't really get into those a whole lot. We do the permanent financing on the backside of a construction loan if that's what you need. But, the construction loan, we typically refer to a local bank that's going to be a short-term.
Brick and mortar.
Short-term 6 to 12 month deal where you're building the house.
In my opinion, in my opinion only, is that the brick and mortar are terrible at mortgages. Only do the construction part with a brick and mortar bank. They are going to fee to death. They're going to underwrite it 10 ways till Sunday. It's like going to that big accountant that has to have 8 reviews of this and that just so that they can justify the billing, right? Same thing here. Be real cautious about getting caught up in the loop of the big banks.
And that's why we're the largest mortgage company in Birmingham.
Yes, the Stagecoach somehow, I do not know how.
They're a bank.
They're a bank. You're the largest mortgage guy. Yeah. Y'all should have been number one.
We are.
Well, no, you're a big deal. But you're a bigger deal than...
We are.
Yeah. All right. A couple other things.
Let's talk about Alabama housing.
Well, let me say... Okay, can I mention one more thought? Because I know y'all don't do this. But if you're a medical professional out there and you are... It's called a doctor loan. Medical residents get them. Can get them, I should say. But there's only a few banks, SunTrust, BBVA, Compass, and a few.
We have one that competes with them. We do okay with it.
But the problem is most of them, you're going to buy over your head, most of the buyers I've seen do it, because they're stroking these banks, not y'all, but a lot of these big banks are stroking egos, right? Because they're wanting the deposits when they become rich doctors. So they give them no down payment, no this, no that, no this.
Which makes sense. I mean, so the doctor program is developed behind increasing income. And yes, you are paying more interest up front to do that doctor loan. There are no ifs, ands, or buts about it. Doctors, when they sign up, they probably realize that, but they're banking into that increased income.
But the problem that I found with it is that they go, well, I can qualify for 3. They're making $45,000 a year, right? And then they go, because they're in their residency. And then they go, well, they said I could afford a $350,000 house. I said, just because they say you can afford it doesn't mean you need it, right? Because we want to set, this is the one time for those kids that they can set their future up properly, right? Because I've seen too many of them get through that residency, not be able to sell for what they bought it for, and now they're in kind of trouble, right? Because maybe if they're going to do another fellowship, sure, their income goes up a little bit, but so does the cost of having 2 houses. Because now you're going to Minnesota. You're leaving Birmingham, going to Minnesota. Are you able to afford those 2 payments? That's the problem I see.
Yeah, absolutely. Now, the last program I want to touch on is Alabama Housing. It's a down payment assistance program. We've got an FHA form, a conventional form. So you're going to put the 3.5% down on FHA. They're going to give you a 3% down payment assistance as a second mortgage. The rates are the same.
So you're saying 2 loans?
2 loans. The rates are the same on the first and the second. On the conventional, you're putting your 97% first, 3% second. Again, this is a good program for the people that work
entry level.
Yeah, the people that works for. The closing costs are a good bit higher on that loan. Is the only drawback that I have with it. I typically try to work people into a 3% down loan rather than.
Is there any income limitations on that?
Yeah, the income limitations on that are closer to $93,000. So
family,
it's a good bit. Qualifying. No,
so whoever's on that
USDA is going to be a household income. Alabama Housing has since changed to qualifying income, which helps out. So your family could make $170,000, but
so if I made 93, my wife made 14, I could qualify only under my own name, even though my wife made 14,000.
Right.
She needs to get a better job, right? If she's only making 14 at that rate, I'm just saying. I'm talking about mine. I mean, if your wife makes 14, nice.
So that's it on the loan programs. I hope that was helpful for you guys. Man, the only stock market update I have right now is Nike.
Now, boy, you talk about real world affecting stock value. Look what happened in the Duke, North Carolina game last night when their star. Is he a power forward?
Zion Williams. I mean, he is a beast. The best player in college basketball. Blew up his shoe, his Nike shoe. It's probably like a size 24. So
blew it up. No. When he says it, literally.
Yeah, they probably don't make that many shoes that big. So I mean, understandably, the margin for error. If you only make like 4 size 63 shoe,
63.
You know, you might screw it up every now and then.
Right.
But yeah, literally he was planting, foot pushed out of the shoe and hurt his knee. Okay, I saw today it's not a terrible injury, but he's definitely going to be out for a little while. Was out for the game.
The Kentucky fans are excited.
But yeah, so that was bad press for Nike. Now we do own shares of Nike, so
out of full disclosure,
I'm not happy about it. But I mean, this is what happens with the stuff we talk about. The other thing was Nike also has put out a shoe that has the shoelaces tied to an app, and apparently they all locked up, bricked the shoe, so you can't do anything because the app is controlling the laces, and they won't. They won't do anything.
Tighten up.
They won't do anything.
One more thing on that is that it's very interesting. Duke, thank goodness, had taken out an $8 million policy on behalf of the player that should he suffer a devastating injury, he would be covered.
Wow.
So good for them taking that. Look, it's part of that recruiting process. We can't pay you now, but we can pay you later. Right, so they'll.
Yeah, but if he plays another game, then they probably won't get that policy. But
yeah, well,
which he will.
Well, let's say he'll probably play. I mean, like you said,
he'll be fine. He'll be fine. He's a beast.
Well, thanks so much for stopping in this week. Don't forget the podcast. The podcast. Yes, we have a podcast. We've had it out for a while now, and you can head on over to anywhere there's great pod, like Apple Podcasts, Spotify. What is it? Google Podcasts.
There you go.
Stitcher.
We'll be there.
Because we're kind of a big deal. So, anyway, we'll see you next week, 4 o'clock, like we do every Thursday.
All right.
Have a great week. Bye-bye.